Okay, all you folks and semi-legitimate people out there, today we're going to be looking at Lyft. If you guys don't know what Lyft is kind of like the smaller competitor for Uber. They're rideshare companies. So basically they're communication services that put people looking for a ride in contact with people that can provide rides. It's basically the next generation of taxi. So Lyft will be the subject of discussion today. It's going to be pretty interesting, so I hope you'll stick around. So the reason we're talking about Lyft again, they reported their Q2 earnings yesterday, August 8th or 7th. I think it was yesterday, August 7th. I think today's the 8th. These guys have a market cap of around $4 billion. They've got pretty healthy volume in daily trading. We're going to be looking at their valuation as well as some of the drivers of that valuation and what their latest earnings report means. Up until this most recent Q2 2024 earnings release, Lyft had only ever reported one profitable quarter. That was Q4 2020. That was a bit of an anomalous reporting. I'm not saying they did anything weird or anything weird in the market happened. I'm just saying it was an unexpected profitable quarter, and it was an outlier if you look at the trend of their finances at the time. And we will be looking at all that stuff. What else is going on with Lyft? They did have a CEO change, and he's done a few really interesting interviews. We're going to be looking at one of them because I think he said some stuff that warrants discussion. His name's David Risher. Seems like an interesting guy. So now that we've introduced the subject and where we're going, let's get into it. Before all that, a little bit about me. I'm just one of those regular old guys. I've been doing these videos for about a week, but I still haven't really settled on a format. I've got these shorts. These are all earnings and news related, but they're all pretty dry. They're not interpretive. They're just reporting on fresh news. Now, what do I mean by fresh? There's this website called earnings.cc. If you go to it, and you can go to this channel's like descriptions and stuff, and you'll see the links. But if you go to corporate earnings, you'll come to this page that looks like this, and you can uncheck a couple of these. I recommend unchecking earnings report and 8K. And this website is likely to change in the near future, but we'll see. And you can see that we get earnings reports, 8Ks and 10Qs. Basically like as fresh as they're reported to the SEC. So if you ever need to know what the most fresh earnings related reports are that are being delivered to the SEC, go to earnings.cc. This is where I get a lot of my information. You can see Kelly Services. They're like a big HR firm. Who else is notable here that's recently reported? Or I don't know. But you guys can feel free to look at that at your leisure, and and let's get back on with the show.
But the thing is, it turns out riders really don't like it. They don't like the variability. And we've seen prime time, that's what we call it inside, surge pricing, go down 25% Q on Q, and that's part of the reason why we're getting great growth. So we actually have a new feature. Yeah, it's called Price Lock, and it allows people who commute to basically lock in a price for the same route every single day for a couple of bucks. It's going to be a great feature. So we're really focused on that, on competing super hard, growing super fast, and that's kind of our focus.
So why did I bring up Lyft CEO David Risher's little dialogue there? And by the way, this is a Q2 interview. So you guys can look it up on YouTube. It's from literally yesterday. But he's talking about the dissatisfaction, the displeasure, the frustration that riders, Lyft customers experience during what they call primetime surge pricing. Now, what is primetime surge pricing? I'm sure most of you heard of it when Uber was coming to your cities and there was a lot of news. And I'm sure many of you have experienced it on New Year's Eve or whatever, right? The idea is that if it's a high demand period, your rideshare rates will increase as demand increases. So, what does this mean in a practical example? Well, let's take the classic example. It's New Year's Eve. It's 1 a.m. or 2 a.m. or whatever time the bars close in your city. Um, it's that time. Everybody's on the street. Everybody needs a ride. Uber rates are $100 per kilometer, right? Whereas normally they're like $2 a kilometer, right? So your $7 trip home becomes a $70 trip home, right? I don't know what other times are classic surge periods. I suspect like Friday, Saturday nights. I don't know. Rush hour. I don't know. Go figure. I'm not a rideshare economist. But think about it. Like put yourself in those people's shoes and think about what that means for their relationship with the service provider. In this case, Lyft. It means that they got you by the balls and they're squeezing because they know they can. And so are you gonna have a positive view of that company after you've had your balls manhandled? Come on. And this is CEO David Reicher recognizing this. He's put himself into the shoes, or he's listened, and he's deduced. Oh, whoa! Maybe let's not kill primetime surge pricing, but let's offer good customers an out. And that's not all he's done, folks, because the out that he's provided these good customers who have high potential for recurring revenues is he's moving them towards what is almost like a subscription model. um kind of like telcos use, telecommunications companies, like your local cell provider or internet provider, um, or like your streaming service like Netflix or Disney, these recurring revenues, right? So what he's promising people, pay up front, will guarantee you pricing, will guarantee you peace of mind, will guarantee you that we won't frustrate you at the time of day that you're already frustrated, and we'll get you where you need to go. Come on, guys. I mean, if that's not corporate leadership that is conducive towards profitability, then you show me an example of what is. So while I was talking, I kind of threw up a few slides there. I'm sure you guys all had a chance to look at them. The first two are revenue slides. That would be the annual and the quarterly. Sorry about those awkward titles. I'm experimenting with some new charting stuff. I know they're a little sloppy. Um, and the idea here is that you can see a general upwards trend. You'll notice most of the bars are above the zero line. In basically since they've gone public, there's only been 4 bars where there was a negative change to revenue. That's not to say that there was negative revenue. I just mean that the amount of revenue decreased from one period to the next. So they have a long trail of growth. Um, the last chart that I threw up there from the last talk was a quarterly net income against quarterly revenue. And so you can see again that the net income is starting to show what might be an upwards trend, while revenue has shown an upwards trend since the pandemic and possibly higher. So that's what those were for. All right, now let's take a look at some net income and other parameters like cash flows. I'm gonna put up a chart here. It's just the annual net incomes. Again, it's got a bad title. I'm not gonna bother cleaning it up. It's the annual net income. You can see again. They had two early. years of decreasing losses. And then starting in the pandemic, they actually started to come up and reduce their losses. They had a bad year in 2022, but in 2023, they had their best year ever. A little bit of a mixed bag. We've got a few spikes to the upside, a few spikes to the downside. Um, I'll tell you the average change for any given quarter over the entirety of this period, going back to Q1 2018, is $95 million positive. The cumulative value of these reports is approaching $2 billion. So they're not doing too bad. Um, And what's really notable here is that the last few years, the last year and a half has only had one quarter where their quarterly loss became worse. To put that in other words, starting in Q1 2023, Lyft has experienced better and better, or smaller and smaller losses until they reported their $5 million profit in this last quarter. That's Q2 2024. Next up, we're going to look at trailing 12-month aggregate change in net income and average trailing 12-month quarterly change in net income. So first, the trailing 12-month average quarterly change. The thing to note here, again, starting in Q1 2023, all the values have been positive. So that's a good sign, okay? That means that they might be emerging into a state of regular profitability. In other words, maybe they're not a startup emerging. I mean, obviously they're not a startup, but maybe they're no longer an emergent unprofitable company. Maybe they're transitioning into regular profitability. The trailing 12-month aggregate change in net income over time demonstrates the same thing. You might be like, oh, well, it's the exact same chart. Sort of, yes, but the scale is different. So again, from Q1 2023, you see exclusively positive values. Those are billions of dollars. Sorry, no, those are millions of dollars. Those are millions of dollars. And so what we're seeing is recurring profitable quarters. All right, so last up, we're going to start taking a look at some cash flow metrics, and that's going to lead us right into some valuation talk. So we're just about wrapped up here. So I've got a set of separated out net cash from operating activities, free cash flow, and quarterly net income. The idea here is that you can see where they start to kind of poke above zero. And for the cash flow metrics, we're talking about Q3 2023. Obviously, for net income, it literally is just this last quarter, with the exception of Q1 2021, or was it Q2 2024, or yeah, Q4 2020, Q4 2020. And then we've also got the same charts overlaid on top of each other. So you can kind of see that they move generally in tandem. But again, focus on that extreme right end where you can see all three metrics are starting to trend upwards. We know that we've got the new CEO, David Reicher, in place. We heard his comments, so that's some pretty smart stuff that guy had to say. So let's just look at some hard dollar numbers real quick. All right, so we're going to look at the income statement a little bit here. Notice the increasing revenue. We're looking at like 40% from same quarter last year. Negative $100 million last year, positive $5 million this year. But the thing to take into account are these other items down here. So there's this 5.8, this 1.9, this 27.3, 4.2, 46.5. These are all stock-based compensation expenses. What does that mean? It means it's not a cash outlay, but it does get subtracted from uh, from this number right here. So really what that means is that in reality, this number is it could be interpreted as 100 million, not just 5 million bucks. Now what else do we have to look at? We have to look at the cash flows. So if we look at the cash flows, we see 432 million from in cash provided from operations. So cash from operations. We see negative 48.9 million in capital expenses, capex, and we see 47 million recuperated return capex. So however you want to call that in your brain. But the net difference, the net investment in capital, infrastructures, and etc., was 2 million bucks. Okay, 47 minus 49, 2 million bucks. So we knocked 2 million bucks off here. 430 million in free cash flow loosely for the 6 months. Now they reported a little bit different numbers here, but whatever. The point is that we're looking at like 150 to 250 million bucks in free cash flow per quarter. So let's call that half a billion to a billion in free cash flow per year, but let's just call it 400 to 3/4 of a billion. So 400 million to 750 million as potential annual free cash flows in the foreseeable future. Now let's jump back to the income statement. Again, if you put these stock-based compensation expenses back into the net income, you end up around 100 million bucks for the quarter. So again, extrapolate that annually, you come up with that 400 million figure again. So not too far off from free cash flow. However, we did see those charts. Let me just pull those back up here. We've got this guy. So again, this is our quarterly revenue. We're seeing quarterly revenue increases to the tune of about 100 million bucks. I think that's where I got that 95 million from, was from the revenue, not from the income. Anyways, whatever. So if we can bake in growth, revenue growth of around 100 million bucks, and if we agree that they've broken that barrier where now they're able to start generating regular profits, we could see a bit of runaway growth, because the 100 million could materialize next quarter. And then the quarter after that, we might see another 50 million because of the 100 million in revenue growth. And so you can see how a year out from today, we might be seeing net incomes of 150 to 250 million dollars per quarter. And again, this puts us up there with those more favorable projections for free cash flow. So if we assign assumptions of about 400 million to 750 million for either free cash flow or net income, and again, let's just take into account these numbers right here, which represent the share counts. Again, we're looking at about 400 million. So what we're looking at is a potential EPS figure of $1 or more. Probably not $2, at least probably not until maybe late 2025, maybe. If the current trajectory continues. But it seems like there's a case here for dollar EPS maybe a year from now. So what does that say for the share price? We all know what typical PEs are. For an established mature company, a PE might be 12 to 20. For a growth company, it might be 20 to 100, 20 to 50 PE. If 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 we postpone our sentiment for a quarter, I would suggest we're likely to see $100 million profit in Q4 of 2024. And so that puts us at a dollar EPS. That would make our current PE 10, right? 1-to-1. You see that we had a 10% increase today. This was after the earnings report was published. The earnings report was published yesterday after close. Now you'll notice here, yesterday they lost 20% over the course of the day. Right away, like at market open, they were down 20%, and they just stayed there. So after they released their earnings, there wasn't a whole lot of overnight or pre-market activity, but over the course of the day, they just earned their 10%. Now, all the markets were up. I think the NASDAQ was up like 3% or something. Nearly 3%. The S&P was up 2.25%. The Dow 1.75%. So they were riding that. But they did well for themselves, and this reflects their earnings report. Again, a growth PE of 20, 30, 50, and a $1 EPS, you can see how there might be a case for 2-3 times growth over the course of the next 6 to 18 to 24 months. Anyways, that's about it, folks. I really appreciate you guys tuning in, and anyone who stuck around this long. Had some difficulties with this video. It's been a while since I've been doing videos, like I mentioned earlier. I still haven't really settled on a format. Again, these videos that exist so far, they're reporting on facts as they come out. The video that I'm giving to you right now is interpretive. That's why it's so long. I also ran into some technical issues because I discovered that with this style of video editing and recording, my computer equipment is just no longer good enough. So I'm going to have to be looking at replacing some of that stuff. So I would really appreciate your subscribes and your likes. I will be doing more interpretive videos, but they will be few and far between. This one is special because, as I hope I've demonstrated, it's a company that has exhibited improving financial conditions. The CEO has some very interesting ideas to share. It appears as though they've broken that glass ceiling where companies are able to operate in a state of profit. And if that's the case, based on the growth rates and the financial metrics that I've shared with you all, it kind of seems like there might be a case for a pretty significant valuation shift to the upside. So good for Mr. David Reicher. And I sure hope a few of you guys go and check out earnings.cc. It will be changing. It will be evolving. I just don't know when. It's an excellent resource. You can see, like right now, it's kind of late, so not too many people will be submitting. But this updates like really very often, and so you can always get fresh info here. So thanks to earnings.cc. Thanks to the viewers. And please like and subscribe. And again, I'm hoping for those comments because I want to know what you guys are thinking.